I'm Justin Boyd, founder of Delta Financial Advisory. Welcome to our monthly market update for April 2025. Large pockets of uncertainty continue to create an environment of elevated volatility for investors relative to 2024's experience. Further weakness in equity markets and digital assets, led by the most growth-sensitive equity securities, created outsized declines in March for investors with overweight risk exposure. GDP estimates for the first quarter of 2025 saw notable deterioration, led by declining growth in consumer spending and after excluding the impact of international gold bullion flows. Earnings per share growth estimates for Q1 were also adjusted in short order. However, Q2 through Q4 earnings per share estimates for 2025 still reflect an expectation that exceeds historical averages, despite the quickly evolving economic and growth landscape. At the headline level, fourth quarter 2024 GDP saw its third revision increased to a 2.4% real rate and 4.8% current dollar pace. However, the real focus of markets has been on the Atlanta Fed's GDP Now tool and other real-time or forward-looking metrics of Q1 2025 GDP and beyond. Of particular note, international gold bullion flows back to the U.S., along with the climbing gold price, captured most headlines in March. Further clarity and additional data points also provided market participants with a clearer view of what really could drive equity prices for the foreseeable future: a significant decline in the pace of consumer spending and real wages, excluding government transfer payments. Shown here is the most recent release of the Atlanta Fed's GDP Now tool. Note the sizable component of dark blue in the bars on the left side of the chart, as pointed out by the red arrow. As we shift our view to the right side of the chart, you'll notice the dark blue bar virtually disappears from view and is replaced almost entirely by the light blue bar. That virtual evaporation of the dark blue bar is the decline in growth of consumer spending. The light blue bars on the right represent international gold bullion flows. While the subject of international gold flows is quite interesting and could be driven by a variety of factors, we will not discuss this topic in detail today out of consideration for a reasonable length video. In our view, the decline in consumer spending in and of itself is enough to warrant significant attention and provides more tangible inputs to equity valuation models. Moving on to headline inflation numbers, we saw the first decline in prices for all items excluding shelter for the first time in 6 months, as shown here by the blue bar at the right side of the chart. Housing costs, as reported by the U.S. Bureau of Labor Statistics, also began to show signs of true moderation. Lastly, however, more supercore metrics of inflation, represented here by the sticky price index less food, energy, and shelter in the green bar, came in stubbornly persistent above 2.5%. We have discussed our view previously that stubbornly high inflation relative to recent decades will persist unless or until the fiscal issues are addressed. This was further reflected in our equity pricing views discussed in these monthly updates. Given our disciplined approach to equity allocation, we welcomed this recent adjustment of inflation and growth expectations, as the resulting correction in equity prices may have finally begun the true journey to more attractive long-term levels. With that said, we will continue to monitor inflation closely to assess whether short-term movements become representative of longer-term themes. Another key metric we have discussed previously and continue to monitor is real personal incomes excluding transfer payments. Recent data has confirmed a breakdown below the important 2.5% threshold on a quarterly, year-over-year basis, with Q3 2024 printing 2.5% and declining to 1.79% in Q4 of 2024. January and February of 2025 have shown real incomes declining to just over 1% on a year-over-year basis. In our view, this metric is inextricably linked with the decline in consumer spending and should not be taken lightly. Many times throughout history dating back to 1960, as one of our favorite long-term chart shows, when real incomes excluding transfer receipts decline below 2.5%, a recession is closely associated. While this has been somewhat muddied in more recent decades in the face of aggressive Federal Reserve intervention, we think the track record of this measure, simply insofar as a predictor of opportunity in the equity markets, should not be ignored. A last headline economic point we'll discuss this month was the sharp rise in the U6 unemployment rate. Specific concerns include a rise of part-time workers by 460,000 to 4.9 million, which was an 8.5% increase. Secondly, workers not currently in the labor force but wanting a job increased 414,000 to 5.9 million people. Simply put, we do not view this trend as even marginally supportive of a broadly healthy labor market and consumer spending environment, and we will be watching very closely over the coming months. There are a few additional notes we think deserve specific mention this month. First, President Trump's address to Congress reconfirmed this administration's commitment to reshoring industrial and manufacturing capacity back to the United States. Follow-on messaging from Treasury Secretary Bessent has been lockstep with the president. Notably, Secretary Bessent has also specifically mentioned on numerous occasions the goal of recapitalizing the private sector. In our view, should these policies be successfully implemented and produce secular momentum, the possibilities for future American prosperity are very real. Additionally, if successful, the potentially painful interim period of natural adjustment recently mentioned to the public should ultimately be just that. However, until increased growth occurs as a result of these initiatives and overall fiscal spend is contained, we maintain a pragmatic view of current circumstance. Stagnating growth and continued financing requirements at the federal and private level could lead to continued economic woes on multiple fronts. Second, China and Germany continue to experience significant economic challenges, with Germany being in outright recession. As a particularly relevant real-world example, 2025 has seen unprecedented restaurant and bar failures in China. While this may not speak directly to the broader aggregate health of the Chinese industrial complex, it certainly speaks to the extremely depressed Chinese consumer. It's this type of global stagnation that we think more US-centric investors should remain well aware of in today's global economy. Lastly, retail favorite GameStop announced in March that it would issue debt to purchase Bitcoin for the corporate treasury. We view this as an excellent example of the human behaviors and thematic groupthink we still see permeating a likely late-stage economic cycle. To be clear, I don't mention this headline as a bash on Bitcoin as an asset or a technology or Bitcoin holders themselves. Rather, as experienced market participants and prudent stewards of client capital, we take particular note of these type of headlines. From a tactical standpoint, a reduced float for Bitcoin should be supportive of pricing, but that store of supply can also function in the opposite direction during market turmoil or declining asset demand. Something we think we do very well here at Delta Financial Advisory is maintaining understanding of and focus on the true drivers of intermediate term economic and market behavior. We accomplish this through a variety of proprietary models as well as decades of experience. This helps us to look past the sensational headlines and often gut-wrenching short-term movements of financial markets and truly wait for potential opportunity or harvest previous gains if we deem the time may be appropriate. If this recent market correction has you questioning your current portfolio's durability or your own risk tolerance, whether you self-manage your portfolio or are already engaged with a financial professional, I would encourage you to reach out to us via the Contact Us form found on our website. We offer a complimentary initial consultation to determine if Delta Financial Advisory may be a good fit for you. Looking forward, we continue to view current cap-weighted valuations of all major equity indexes as elevated, with continued reliance on robust growth expectations that appear increasingly less likely to occur. We would also note that a recent emergence of slowing international capital flows to the U.S. has continued, and the extent and impact on U.S. financial markets going forward is yet to fully be seen. While a near-term recovery rally from late March's declines could occur in the equity markets, our portfolio allocation continues to focus on relative versus total performance, maintaining a moderate underweight of equities and duration. Specifically in regards to the fixed income universe, credit spreads remain at the bottom end of historical ranges despite the uptick in uncertainty and volatility of late, as well as known debt refinancing needs in the near future. As such, we remain disciplined in our overall risk allocation and await more attractive valuations across the risk asset spectrum. Thank you for watching. If you gained value from today's content, we always appreciate a thumbs up for this video and a subscription to our channel. If you'd like to learn more about our practice, please visit our website via the link found right here on our YouTube page or directly at deltafinancialadvisory.com. We wish everyone health, prosperity, and successful investing.
The information and commentary contained in this video are for general informational purposes only and do not constitute financial, investment, or other professional advice. Always consult with a qualified financial advisor before making any investment decisions. Investments carry risks, including the potential loss of principal. The content is based on current market conditions and is subject to change without notice. The firm is not responsible for any errors or omissions, or for any actions taken based on this information. Past performance is not indicative of future results. This material does not constitute an offer or solicitation to buy or sell any securities.